Hello, everybody. Welcome to the newest edition of the PFA Quarterly Commentary Update. It is just about beginning of August now, August 4th, but we are recapping quarter number 2 and giving a little outlook on what we're going to be watching into the future. As always, I'm joined by James Bradley.
As always, I'm glad to be with you, Sam.
Yeah, glad to have you here. So we're going to try to keep this short for you, jump right into it. Same format. Start off with the economic review. You're going to see us talking a lot about inflation. That is the hot topic that everybody's talking about. Obviously coming out of a pandemic and a bit of a crisis, money supply has been increased dramatically. Right. This first slide is going to look at commercial bank deposits, which shows that there's a lot of money sitting on the sidelines, more than at any time in the past, and that is increasing the risk of inflation. A lot of conversation about whether this inflation that we've seen in recent months is going to be sustained or transitory. Maybe some people call it structural or transitory. Is it going to go away over time as the baseline catches up? Right now, we're comparing prices to a year ago, where prices were a little bit suppressed at that point since demand was down in a big way. But as we move forward, are we going to see things level out a little bit? That's a big conversation that people have very strong opinions on. You find people very strongly on one side or the other, not a lot of people in the middle, but we're going to give you a couple reasons it could be sustained, a couple reasons it could be transitory. This commercial bank deposits is an area where it can be a little scary and could be sustained if all this money starts getting deployed into the economy and pushes up a lot of demand, a lot of upward pressure on prices from that extra money chasing the same amount of goods. So that's one reason that there could be some sustained inflation if people do go out wholesale and start spending all their money. I'm gonna kick it over to JB for the second slide.
Sure. With that's commercial bank deposits, if we look at another kind of way, similar types of information that we can get out of just looking at general household wealth, not just including what's sitting in the bank, but what's overall a part of the assets that could be chasing, again, like you say, limited goods and services in the economy. Certainly a big spike, a year over year change of almost 25 billion. I want to say billion as a big number, $25 trillion. That's a lot of zeros. That's the largest percentage that we see there is also held by people in the age 55 and up category, my homies. So and these are the people that are more inclined to probably chase some of the service types of parts of the economy that are certainly under a little bit of price pressure right now. And so that could go either way, I suppose. Some of these areas, as they kind of fill out and things get back to normal, could see their prices, get back down into kind of normal trends. So that could be another part of the argument for transitory, but also, just general wealth increases overall, especially a spike over a short amount of time.
It seems like it should be a good chart, right? Everybody's wealth is going up, but if everybody's wealth goes up, then nobody's wealth really goes up because the prices will rise to match that. We did a whole podcast on inflation recently, if you guys want to check that out. But an interesting concept there about why maybe we haven't seen as much inflation after the financial crisis was that changing demographics in the U.S. and as older people accumulate more wealth, they're a little more prone to save it than they are to spend it, especially as they're approaching retirement age. So that leads to those higher bank deposits that we just mentioned.
Sure. And if we look at areas where areas that are driving inflation right now, the price increases that we see right now that are making headlines, where are those? Those are happening in things like used cars and trucks, transportation services, a lot of supply chain issues that are going on there. Those are, by pretty much anybody's definition, issues that are probably transitory. And you look at something like food, which doesn't tend to increase or decrease as far as the way people consume it, based upon the economy, and that's staying a little bit more in the middle. So 1.5% of year over year CPI increase is the result of just used car prices alone, which is a huge part of that. And again, likely transitory. 1% is attributed to baseline effects. So even the inflation that we're seeing right now, there's a lot of good hope anyway, I guess, that that what we're seeing is healthy and likely not all that very long term.
Yeah, it's a kind of an anomaly there with the used cars. I saw that the used cars have only about a 3% weighting in the CPI, but the prices are up about 45%.
Wow. Yeah.
So that's what leads to that 1.5. So you pull that out of the about 5% CPI print we got recently, brings you down to about 3.5 is another about percent that they're attributing to the baseline effects of the fact that prices were depressed a year ago, and we're comparing to those prices.
Sure.
So there's a silver lining there if you dig into the numbers a little deeper. Another silver lining here supporting the transitory argument is that production remains pretty low. As Fed Chairman Powell said, this has kind of been the perfect storm of, your increasing demand with all the stimulus we've done. At the same time, supply chains are under a lot of pressure. So demand going up, supply going down, raises prices. So that's one indication here is that production remains below its long-term averages. There's still a lot of room for the supply side to ramp up and increase a lot more goods and services out there. And as they do that and supply chains normalize, we should see some normalization in prices as well.
What you're saying there, it looks like, when you look at the supply demand curve, demand is obviously boosted up a lot, but there's hope that supply can maybe keep up.
Next slide. Another area here is labor distortions. We've seen that huge spike in unemployment. Recently, employment rate around 5.9%. We did get a disappointing jobs number out today, but overall, a lot of the jobs that we lost, about 16 million jobs, I think we've gained about 13 million of them back. So it's a fairly substantial recovery there so far. But you can see the job openings number is now matched the unemployed people's number. So there are enough jobs out there for everybody. But it gets a little hairy if, a lot of people are not rejoining the labor force as quickly as a lot of economists would have liked to see. And what happens there is jobs have to start kind of bidding to get people back into the labor force by raising their salaries. We've been seeing a lot of that across, every sector from, fast food restaurants to banking sectors, where prices or salaries rather are coming up to entice people to come back. What you got to worry about there is something called the wage price spiral, which is that it sounds complicated, but pretty intuitive actually, that if you start getting paid more, you're spending more money. You're spending more money, that increases the prices because the push up on demand, and then you require more money again. So, go ask for a raise, you spend that money, prices go up, you ask for a raise again. And that's something to be watchful of. So a lot of people keeping a close eye on this wages and salaries here in the US, which you can see has gotten back in line with its long-term trend, which is not a problem. But if you start to see some substantial increases there, that's a sign of more structural inflation that could be a problem. On this final slide here of the economic review, this is the forecast for the PCE, which is the preferred metric for the Federal Reserve measuring inflation. And right now you can see they typically target around a 2% inflation rate. Recently, they've said they're going to let that run hot a little bit. But the forecasts here are not so concerning. You're seeing a quick spike up here in 2021 and leveling out after that. Devil's advocate, these are coming from the Bureau of Labor Statistics and closely aligned with what the Fed is saying. Devil's advocate would say, the Fed is not going to come out and say that inflation is going to run away, right? If they did say that, then it certainly would, because everybody would go out and everybody would go out and start spending their money before the purchasing power erodes. So, grain of salt there always. But that's what we're looking at for the forecast for inflation at the moment. Not too concerning, as the policymakers are saying. A lot of people saying it's going to be transitory. I've found, I talk with a lot of fund providers, JP Morgan, Goldman Sachs, a lot of people out there, and ask this question. It's always the first thing that they want to talk about. And I found that everybody that sells a commodity fund wants to say that inflation is going to be very structural, or the people that aren't are saying it's not going to be. So you always got to be considering
the source.
Exactly. All right. Can hop into the market review. I'll kick this one off. Equity valuations here is the chart we'd like to take a look at pretty much every quarter. And it's showing in the chart, the line chart is the forward PE. You're seeing a pretty high level there, 21.53 PE ratio versus a 25-year average of 16.71. To be straightforward, this is a pretty high valuation level, and this is on a forward basis too. So it's not like we're comparing trailing earnings to prices, which were depressed from the pandemic. We're looking at prices per share divided by the forecasted earnings per share, and it's looking pretty high. So the only way this comes back down is if either prices come down or if the forecast of earnings go up. These things tend to revert to the mean over time. There's a lot of other valuation metrics in the table there that also generally say that the valuations are looking pretty steep at the moment. The only one that's saying it's not is the earnings yield spread, which is an interesting one too, because that's looking at the reciprocal of the price earnings ratio. So if you took an earnings per share and divided it by price per share, that's your yield at about 1.28% right now. And you compare that against the fixed income corporate bond market, where an average corporate bond BAA is getting 0.09% yield on interest. So that supports stock prices. There's not just by the fact that there's not really an attractive alternative to go towards. So if we do see interest rates start coming up, you can be sure there'll be a little bit of a flight from stocks over to interest, over to fixed income as they become a little more appetizing.
I guess the Cliff's Notes version to this slide is stocks are expensive relative to historical norms, but not expensive relative to where else can you put your money in the market.
That's a good way to put it. Absolutely. So again, there's a little bit of a silver lining here in that those are the average PEs, but there is a wide dispersion among stock valuations at the moment. Here we're looking at the median PE, so the one in the middle of the S&P 500. In the middle, we're trading at about a 19.8 right now versus the 15.9 on the long run average. So a little bit overvalued from that standpoint. But if you see that dark gray shaded area, that's showing this valuation spreads. And you can see that really skewed to the upside right now, which means about half the stocks there on the upside have really high valuations, but there's still a decent amount under that median where there's some value opportunities. That becomes an opportunity for stock pickers to be careful and not be chasing those manias that are up very high. I think we mentioned in the past, the S&P 500 is weighted by market cap. So things like the Googles and Apples that have PE ratios up in the 28-30 range have an outsized effect on the overall average. However, that they don't make up the entire stock market. So that's right. something to be aware of.
Okay, growth versus value, and this is another kind of a takeoff on what you were just saying there, Sam. The big gains that we've seen pretty much since the beginning of the pandemic, and frankly over the past 10, 15 years, have largely been on the growth side of things. When we talk about growth, we're talking about stocks that typically do trade at those higher price to earnings multiples because they think those earnings are going to be going up over time, relative to a stock that might not trade at such a high multiple, but gives off reliable earnings and potentially dividends on a regular basis. So the former, the go-go things, are considered growth. The latter, the things that are a little bit more steady Eddie, are considered value. And there's ways that we can kind of differentiate between the two. But what we need to really pay close attention to here, and this has been coming on for some time, as you can see. I mean, this graph goes back all the way to the early 1990s, early and mid 1990s, is that there's been a pretty steady progression of growth outperforming or outgrowing, I guess, value stocks. And we're to a point right now where that the premium essentially is being paid to investors is at the largest point ever. And it was at the largest point ever before, we went into this recent correction, but it's back up there again. And so often value outperforms in recessionary periods. This is one of those periods where we're saying, is it time for value to outperform? We're not looking at a recessionary period. We're looking at a period where the economy is heating up. So we're seeing, something that's really giving us a sense of, value should outperform, but we're in definitely uncharted waters when it comes to how do we expect value to outperform as long as the economy is still heating up. So it'll be interesting to see how this plays out. But it's hard to argue with the idea that growth has maybe had its time relative to value, and that value may have a little bit more cheerful prospects in the foreseeable future. So jumping off of stocks for a little while, and just looking at my favorite area, the bond markets. The only thing that, the bond markets are, again, just like we're seeing with growth versus value, we're looking at uncharted territory. But looking at uncharted territory on the bond markets too. We're looking at, now looking back beyond the end of the second quarter, over the month of July, the 10-year Treasury actually dropped 25 basis points, from about 1.5 to 1.25 in its yield. In other words, people are piling their money into bonds at the same time as you wouldn't expect them to necessarily be doing so, because of the fact that the equity markets are doing well. So what we've seen since August of 2020 is definitely a curve that's trending more toward normalization, steepening up a little bit, giving people more return for longer time deposits in guaranteed government debt. But as you can see, the blue line has dropped off a bit from the gold line. The June line has dropped off from the March line on the far end, and it's continued to do so. So we've been seeing a little bit of a curve flattening. Curve flattenings tends to kind of indicate a market that's looking for a slowdown in growth and or a recession if it gets so flat that the long-term end goes lower than the short-term end. We certainly don't see that currently. We certainly don't see that as a probability in the near term, but it's interesting to watch and to try to figure out why that's the case. So for some reason or another, the bond market and people in the bond market are still not needing to be rewarded substantially for locking up their money for a long-term period of time.
Yep, that is the case. So a few things we'll be watching looking forward. Jim, you want to talk a little bit about economic growth estimates?
Sure. So, the bond market's telling us one thing, everybody else is telling us other things, and it's one of those kind of interesting times to be in the business. Yeah, and it's not surprising. Anytime you get this kind of a substantial shock to the economic system and this kind of a huge response to that shock that we've seen fiscally, domestically, and across the globe, you're going to see things that don't necessarily line up with their historical norms, I think, in a lot of ways while we work these things out. One thing that's been interesting to see is kind of adjustments to how are we going to grow out of this? And almost universally, the answer is pretty rapidly. The Morningstar is showing us an estimate of about 6% US GDP growth on their June report. And that's down a little bit from where they were estimating it to be back in April, but significantly up from where they were estimating it to be before, the vaccination stats started to roll out really well when they came out with these in February. So a little bit of a retracement of their exuberance, I guess you could say, as to where we'd be in 2021. But look ahead the next couple of years. They're also predicting relatively significantly higher growth than originally forecast in 2022 and 2023. So certainly there's some hope there. And I think what we're seeing more than anything else is economists started to say, yes, we're going to get this, relatively go-go growth that we were originally planning, but because of things like, you name it, Delta variant, what have you, that may take a little bit longer and be a little bit longer in the tail to manifest itself. So it'll be interesting to watch, but we certainly by 2024, 2025, we go back toward trend. The interesting thing here is that after all is said and done, it looks like we leave with a trend line that's not all that very different from where it would have been before the pandemic. So the overall effects of the pandemic may go away completely after time. Shifting growth prospects is the slide that we see here, and right now most of that growth as we come out of this is coming from developed markets. But JP Morgan and their release here from June has been pretty clear about them thinking that is going to switch places a little bit, and that developed markets are going to continue to grow, but at a slower seasonally adjusted rate relative to emerging markets, which are going to start to take over potentially as early as the fourth quarter of this year.
Yeah, developed markets definitely had a lot more power to buy themselves out of the pandemic, the stimulus, monetary and fiscal policy, where emerging markets not so much, but returning to emerging markets having higher growth is kind of the typical state of affairs that we want to get back to.
Right.
Moving over to a pandemic that is not over. I don't think anybody wants to keep hearing about the pandemic, but unfortunately, it is still here with us, and we're seeing what looks like a fifth wave due to the Delta variant. Um, you know, as Jerome Powell said, each wave of the pandemic has had less economic impact as we've become more resilient to it. It's not like all the businesses need to reinvent the wheel all over again. They've been through it a few times before. However, it will still have an economic impact. This is just showing that cases ticking up here. On the next slide, we're looking at the vaccination rates. New estimates about herd immunity. They used to say 65, 70% to get to herd immunity. Now with the Delta variant out, we're hearing numbers closer to 80, 85% vaccination rate in order to reach herd immunity. Unfortunately, a little daunting that we're only at about 50% right now. So there's still a lot of room to make up to reach herd immunity there.
I did hear recently some encouraging news out of a place like Louisiana, where there's, only over the past few weeks, partially as a result of the Delta variant, partially as a result of maybe people seeing more and more evidence that the vaccines work, that there's been about a 40% pickup in vaccination rates in some of those areas. So
oh, good. Yeah, a lot of places are getting inventive with the lotteries and such too, which is good to see. Whatever you got to do.
Right. Oh, I'm going to jump on this one. Yeah, as we look at markets that are certainly showing price levels relative to earnings that are higher than normal, as we're looking at the potential for there being some froth, we'll call it, in equity market valuations and that type of thing. And at the same time, as we're looking at a pandemic that's clearly not over, and that we've got some room to go, it starts. One of the things that starts to catch my attention anyway is the amount of leverage that people are using in their accounts. And this graph that I was able to create from data from FINRA shows just overall debit balances in customer security margin accounts. In other words, when they're buying stocks and bonds in their portfolio, how much of it are they actually borrowing money to buy? And as you can see, there's been a pretty sizable, jump upward. And this is what, over, the past, less than a year, really, that we've seen such a pretty significant spike upward in debit balances. Where that creates potential concern is that if the Delta variant slows things down relative to where we thought we were going, or if people realize, gosh, stocks are priced at a level that they're not all that very comfortable with, and we do have some kind of a correction, or a market downturn, which we frankly haven't seen a substantial one in now over a year. Are we going to see that get exacerbated by people having to unwind positions due to margin calls and that type of thing? So whenever we see this kind of a spike upward, it's not in and of itself something that is a bad indicator, so much as it's something that says if everything else kind of ganged up and we did have a bit of a pullback, that pullback could be a little bit more sharp than otherwise it would be if people weren't as leveraged up in their accounts.
Agreed. There's been a split where during the pandemic, consumers have actually improved their balance sheets, and we saw those high bank balances and paying down a lot of debt and whatnot. But on the investment side and the corporate side, money's cheap, and when money's cheap, people tend to lever up.
So true. We're seeing a market right now, as of the date of us recording this, volatility in the market is not very substantial. There are things out there that lead us to think that we could see volatility pick up. And if and when we do that, I always like to kind of go back to this slide. JP Morgan's been including it in their guide to the markets for many years now, and just kind of keep it up to date year to year. It shows you, where the S&P 500 ends each year as far as a percentage increase or decrease, but also on that same chart, the dot plot for how far of a top to bottom fall happened at any given point during that particular year. So on average, it's important to point out that we see intra-year drops of 14.3%. We've seen nothing close to that so far this year. The biggest drawdown we saw was 4%. Despite that, though, it's important to keep in mind annual returns are positive 31 of 41 years. We're going to tell you the same thing as I hope just about anybody in the market tells you, which is that we don't know if and when the next big downward spike is going to come, but this is the graph that you need to kind of go back to and look at and say, they do happen. They happen relatively frequently historically, these downturns, and they're good things to ride out, because overall, over that period of time that they've measured the market from 1980 through 2020, so far in 2021, we're looking at an annual average rate of return of 9% on the market. It's still been worthy of hanging out through those downsides.
Yeah, reminds me of a study Fidelity did a couple of years ago. It's just a great anecdote to explain this, is that they were looking into some of their highest returning accounts and trying to identify what characteristics these people had in common. What might lead to being a person who has outsized returns. And the only two characteristics they were able to come up with was people who were dead or locked out of their accounts. So it just kind of goes to show that sticking to your guns, staying in the market is the way to go. I think as financial advisors, it's some of the best value we can provide you is not letting people succumb to the behavioral biases we all have of wanting to panic sell and FOMO buy. And it just generally doesn't work out. So even though you will see some drawdowns like this over the long term, you're going to be just fine.
An old kind of mentor of mine always put it, we're not going to keep you off the roller coaster. We're just going to make sure you don't jump out of the car.
Nice. Couple of quick last slides here, just about shifting employment prospects. Obviously, we're not going to come back to the same normal we had before the pandemic. The job market will come back, but it might shift a bit. And this is showing some of the jobs that might have the highest growth prospects. No surprise there with epidemiologists and medical scientists. Web developers also makes a lot of sense. But then on the other side, on the downside, you're looking at hosts and hostesses, bartenders, reservations, a lot of kind of leisure and customer service positions that could be in for a little bit of a diminishing prospect going forward.
Not many big surprises there. And I think this says a lot to that graph that we saw earlier, where we've got 8 million job openings and 8 million jobless right now. And I think that in a lot of cases, some of these job openings are on that earlier slide and some of the jobless are on this slide. Unfortunately, it's going to take a little time to sort that out.
Yep. Great. Well, that's all we have for you today. Thanks for joining us, and we will see you next quarter.
Thanks, everybody. See you next quarter.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.